Welcome to ACCA Masters. In this video, we'll discuss the following topics like tax year, computation of taxable income, personal allowance, adjustment to personal allowance, what is adjusted net income, marriage allowance, difference between income tax payable and income tax liability, qualifying interest payments, and child benefit charge. So, start with tax year. Individuals are assessed to income tax on their income arising in a tax year. In UK, tax year starts on 6th of April and ends on 5th April. And for the Finance Act 21, tax year 21 means that year starts on 6th April 21 and ends on 5th April 22. Now about computation of taxable income. An individual income from all sources is aggregated in a personal tax computation for each tax year. Format to be followed. First, we need to consider the non-saving income in the second column. Then it will be saving income, then dividend income, and here we need to record first of all trading income, employment income, property income and pension income. These are our non-saving incomes. This is a basic format. Then there is a building society interest, which will be recorded in saving income. Then bank interest, in the column of saving income. Then dividend, which will be recorded in last column of dividend income. And when you have all these income, this is said to be your total income. Some reliefs are allowed in UK, which are said to be relief against total income. And in this video, we will discuss a relief of qualifying interest payment. So first, from total income, we need to deduct the relief and we'll get the net income. And then we need to deduct the personal allowance which is available to individuals in UK, which reduces their taxable income, and hence we will get the taxable income. So first we need to aggregate income from all sources and then apply relief, and then sequence wise next is to apply personal allowance in order to calculate the taxable income. Another term is used is exempt income. Exempt income is said to be income from certain investment that is exempt from tax under the UK tax rule. They are therefore useful for tax planning. Personal allowance. Every taxpayer is entitled to a personal allowance. This personal allowance is an amount of tax-free income that every taxpayer is entitled to each tax year. The amount is reduced to nil for high-income individual. For the current tax year, the personal allowance for the year 21-22, it is 12,570 pounds. For F6 TX paper, your personal allowance always be deducted from the taxpayer's net income from different sources in the following order. First, personal allowance is deducted from non-saving income, then from saving income, then if there is any remaining personal allowance available, it will be deducted from dividend income. Assessable persons. All individuals are said to be assessable persons, including children. Both spouses within a married couple are treated as a separate individual for the purpose of income tax. And all persons resident for tax purpose in the UK are assessed to UK tax on their worldwide income. Now, before considering adjustment to personal allowance, we need to consider the adjusted net income. What is meant by adjusted net income? It is said to be net income minus donation under gifted scheme and secondly contribution to personal pension fund. We will discuss about the personal pension fund later. And both these amounts are considered as gross amount. Means the gross amount of donation under gifted donation and gross amount of contribution to personal pension fund would be deducted from net income in order to calculate the adjusted net income. Now, adjustment to personal allowance. If individual's adjusted income, if individual's adjusted net income is between 1 lakh to 1,25,140 pounds, his personal allowance needs to be adjusted. The stepwise approach. Step 1. Identify income. In fact, adjusted net income in excess of 1 lakh pounds. Then, in step 2, divide this amount, which is calculated in step 1, by 2, and then in step 3, reduce the amount calculated in step 2 from 12,570. So first we need to identify what is our adjusted income, net income in excess of 1 lakh pound, then divide that portion by 2 and whatever is the outcome, it reduces the personal allowance. So it would be deducted from 12,570. For example, if a person has adjusted net income of 1,10,000, then in accordance with this stepwise approach, in the first step, we need to identify how much adjusted net income is in excess of 1 lakh. So 1,10,000 minus 1 lakh, and we'll get the excess amount of 10,000. In the second step, we need to divide it by 2. So 10,000 divided by 2 gives you 5,000. And in the third step, you need to reduce this 5,000 from the personal allowance amount. 12,570 minus 5,000 is equal to 7,570. So remember that if your taxable income or adjusted net income is in between 1 lakh to 1,25,140, you need to adjust your personal allowance, and this adjustment works as follows. First, we need to identify the income in excess of 1 lakh, then divide it by 2, and then reduce it from 12,570. But remember one more important thing, that the personal allowance is reduced or reduced potentially to nil for high income individual. So we'll verify this. What if the adjusted net income is 1,20,000? In that case, again we need to identify the portion in excess of 1 lakh, which is 20,000, divided by 2, we'll get 10,000, and subtract this 10,000 from the personal allowance of 12,570, and we'll get our adjusted personal allowance as 2,570. So as a result of increasing in adjusted net income, our personal allowance reduced to 2,570. Now take another example. What if the adjusted net income is 1,25,000? Again, we need to identify the portion in excess of 1 lakh, which is now 25,000. Divided by 2, we'll get 12,500, and reduce that amount from 12,570, and we'll get our adjusted personal allowance as 70 only. And if our adjusted net income is said to be 1,25,140, in that case, excess portion is 25,140, half of which would be 12,570, and when we'll deduct this amount from our personal allowance, the remaining adjusted personal allowance will be nil. So that is why it is said that if your adjusted net income is in between 1 lakh to 1,25,140, it needs to be adjusted. But if your adjusted net income reaches the level of 1,25,140, there is no personal allowance available to that particular individual. So next is marriage allowance. If you are married or in a civil partnership, one of you can transfer up to 1260 of your personal allowance to other. In fact, exactly 1260 for TX purpose. This is just 10% of the basic 12,570 rounded off for the 21-22 tax year. So as a result of marriage allowance, this allows a spouse or a civil partner to elect a transfer a fixed amount of personal allowance to his or her spouse or civil partner. The marriage allowance is also known to be transferable amount. Electing for the marriage allowance allows the transfer to the other to transfer some amount of personal allowance to other civil partner or spouse, a fixed amount which is 1260 for the tax year 21-22. Implication of such personal allowance for such marriage allowance for transfer. Transfers personal allowance reduces by 1260, means his transfer his personal allowance after transfer would be 11,360, 310. After transfer, the personal allowance available for the transfer reduced to 11,310. But in case of recipient of marriage allowance, for the recipient, his tax liability reduces by 20% of that transfer amount, and that is exactly 252. So this is said to be reduction in tax liability, not taxable income, tax liability of recipient. Before considering example of marriage allowance, we will consider the difference between income tax payable and income tax liability. If the taxpayer has paid some tax during the year, then his tax liability would be reduced by that amount. Like if my tax for the tax year 21-22 is 10,000, right? But during the year, I have paid some amount of 8,000 as tax. So as a result of this, my tax payable amount reduces to 2,000. So when we deduct tax paid from income tax liability, we will get the amount of tax payable. Remember the rate band for the tax year, for the current tax year, basic rate band is for the individual who earn up to 37,700, he has to pay tax at the rate of 20% up to the income 37,700. Higher rate band which is from 37,701 to 1,50,000, and the individual who has a taxable income in between these two figures 37,701 to 1,50,000 has to pay tax at the rate of 40%. And then there is an additional rate band, individual who earn above 1,50,000 pounds has to pay tax at the rate of 45% on income above 1,50,000. Now we will consider some example to calculate the tax liability. Now the first example is the individual has a taxable trading income of 30,000 and employment income is 3,000. We need to calculate tax liability here. So first we record the trading income. That is 30,000. Then we need to record employment income. That is 3,000. And the total income of that individual would be 33,000. There is no relief in this particular example. So it is a basic example. So we just need to deduct the personal allowance, which is 12,570 for the current year. So taxable income of that person, would be 20,430. And as his 12,000 his income lies on the basic rate band, means his income is up to 37,700, so it will be taxed at the rate of 20%. So 20,430 at the rate of 20% gives you a tax liability of 4,086. Now what if that individual person has a trading income of 60,000 and employment income of 6,000? In that case, again we need to record first trading income, which is 60,000, add employment income, which is 6,000, and hence we'll get the total income 66,000. Now deduct the personal allowance, which is 12,570, and give you a taxable income of 53,430. Now we need to apply a different band rate to calculate the tax liability. So up to income of 37,700, it will be taxed at the rate of 20%. So create a tax liability of 7,540. And for income above 37,700, means the difference between 53,430 and 37,700, that will be 15,730, and it will be taxed at the rate of 40%. So it will be 6,292. So the total tax liability would be 13,832. Next, we need to consider some more increment in his income and implication of tax liability on that income. Let's say if that individual has a trading income of 1,60,000 and saving income or if we consider that there is no saving income, in that case 1,60,000 and consider that if an individual has a taxable income or of greater than 1,50,000, like if he is a trading income of 1,60,000 and employment income of 20,000, then his total income would be 1,80,000. Remember that if a person has a adjusted net income greater than 1,25,140, there is no personal allowance available to him. And how to calculate adjusted net income? Adjusted net income is calculated as net income minus contribution to personal pension fund and donation to gifted scheme. In this question, there is no contribution to personal pension fund, no donation to gifted scheme. So that is why the total income is equal to adjusted net income. Remember that the sequence is that first we have to deduct the relief from total income to get the net income. So there is no relief So total income and net income is equal. Then there is no contribution to personal pension fund or gift aid scheme. So adjusted net income is said to be equal to total income. Now we need to consider that our personal allowance is here 0. So that is why it is necessary to write 0. So that is why taxable income would be 1,80,000 also. Now we need to apply the different rate band. In accordance with basic rate band, income up to 37,700 would be taxed at the rate of 20%, and that would be 7,540. Then higher rate band, and the income between 37,700 to 1,50,000, which is 1,12,300, would be taxed at the rate of 40%. So this would be 44,920, and income above 1,50,000 would be taxed at the rate of 45%. Remember, we have an income of 1,80,000, which is 30,000 in excess of 1,50,000, and this will be taxed at 45%. So the tax liability would be 13,500. So this is our total tax liability. Now we need to consider the implication of a transfer of personal allowance, like you can say marriage allowance. What is the benefit for the transfer and transferee in combination? For example, if a Jack, one spouse has a total income of 30,000 and her other spouse Mary has a total income of 8,000. What would be their combined tax liability in case they decided not to transfer their marriage allowance or personal allowance to other party? So in that case, the tax liability of Jack would be his total income is 30,000. His total income is 30,000. After deducting personal allowance of 12,570, his taxable income would be 17,430. So tax on this 17,430 at the rate of 20%, because his income is up to 37,700. So the tax liability would be 3,486. While in case of Mary, she has a taxable income of 8,000 and total income of 8,000. After deducting personal allowance which is available to her, but she has not much total income, so personal allowance of 8,000 will be used to make her income 0, taxable income 0, so she has no tax liability. If they decided to transfer the marriage allowance, in that case, Jack will transfer. If they transfer the marriage allowance, means Mary transfer her personal allowance, 1260 pound of her personal allowance to Jack. In that case, the total income of Jack remains the same. The personal allowance to be deducted also remains the same, 12,570. And the taxable amount would be same, tax liability would be same. What is the procedure? We have discussed that the recipient tax liability would be reduced by 252. And how this 252 amount is calculated? 20% of 1260. So the tax liability which we have calculated as 3,486 would be reduced by 252 and reduced to 3,234. So as an implication of receiving marriage allowance or personal allowance of 1260, there is nothing to change in his personal allowance. Just what we need to do, the tax liability of 252 would be reduced. And in case of Mary, she has a taxable income of 8,000 as a result of transfer of 1260 of her personal allowance. Now her personal allowance reduced to 11,310. In either case, her personal allowance is greater than her total income. So, her total income will reduce to 0 and she has nothing to pay tax. So, the tax liability would reduces from 3,486 to 3,234 in case of transfer of marriage allowance. Now, we need to consider the relief against total income. Tax relief is available for certain payments made by an individual and also for trading losses, which we will discuss in later lectures. Relief is available by deducting the payments from the total income, as we have discussed in the format that from total income first to deduct the relief and then we will get the net income, and from this net income we have to reduce the personal allowance. The only payment deductible from total income which are examinable in your F6 paper is qualifying interest payment. So, qualifying interest payment is said to be relief given on interest paid on loan. That loan is incurred to finance expenditure for qualifying purpose. If loan is taken for some qualifying purpose, then interest paid on that loan is considered as relief. Now, what is meant by qualifying purpose? What is said to be qualifying purpose? So, there are some qualifying purpose. Number 1, loan to buy plant and machinery for use in partnership or employment. Second, loan to invest in partnership. Third, loan to buy interest in employee controlled company. And fourth, loan to invest in cooperatives. For example, if number 1 again Jack has total income of 65,000, right, and she made interest payment, he has made some interest payment during the year 4,000, and the purpose of interest payment is on his mortgage for his private residence. The interest is paid on a loan which is obtained to construct or for the addition of the private residence or for the acquisition of private residence. But we know that this is not said to be the purpose, qualifying purpose. As we have considered, this is not said to be the qualifying purpose if you have taken loan for the construction or acquisition of private residence. While in case of Roger, who has a taxable income of again 65,000 and he has also paid interest of 4,000, but this is interest on a loan which is obtained to invest in partnership. A loan is obtained to invest in partnership. So, what are the implications? In case of Jack, there is no deduction of interest payment from his total income, and his income is 65,000, 12,000 of 570 of personal allowance would be deducted from this, and the remaining would be considered as 650, 2,000 and 430 as his taxable income on which he has to pay tax. While in case of Roger, his income is again 65,000, but as a result of paying qualifying interest payment of 4,000, his total income reduces to 61,000 of net income. This is his net income. And from this we need to deduct the 12,570 of personal loans. So he has a taxable income of 48,430. So as a result of interest payment for qualifying purpose, the taxable income reduces of that particular person. Now we need to consider the child benefit charge. the last point, it is quite similar to adjustment in personal loans. Child benefit is a tax-free payment from the government that can be claimed in respect of children in UK. However, a child benefit becomes tax chargeable where an individual has an income of more than 60,000. So we can say here, if an individual has a taxable income or said to be adjusted net income between 50,000 to 60,000, then there is need to calculate the child benefit charge, right? The stepwise approach is quite similar to that of personal loans. Number 1, identify adjusted net income in excess of 50,000. Then step 2, divide it by 100, and now this is the percentage that is chargeable. Means you need to calculate child benefit tax charge. For this you require some percentage. Now this is the percentage. On this we have to consider the tax charge. So for example, if a person has a taxable income of 54,000, adjusted net income you can say of 54,000, and he has received some child benefit of 2,000. This is the example. A person has a adjusted net income of 54,000 and child benefit of 2,000. So first we need to calculate his tax liability simply. He has a 54,000 of adjusted net income. Deduct 12,570 of personal allowance, and he has a taxable income of 41,430. Up to 37,700 he has to pay tax at the rate of 20%, which is 7,540. Now we need to consider the excess income. 41,430 minus 37,700, this is 3,730, and it will be taxed at the rate of 40%. And that is 1492. So this is his tax liability. $9,032. Now we need to calculate the child benefit charge. He has received a child benefit payment of 2,000. So first we need to consider the amount, the adjusted net income in excess of 50,000. 50,000, that is said to be 4,000. Divide this 4,000 by 100, we will get 40. This is the percentage. Now child benefit charge would be calculated as child benefit payment multiplied by this percentage, and this will be 800. So the 800 amount would be added in his tax liability, and his total tax liability would be 9,832. So as a result of receiving child benefit payment, a person has to pay tax on child benefit, which is said to be child benefit charge. It has to be paid if a person has an income or adjusted net income between 50,000 to 60,000. Like if he has a taxable adjusted net income of like say 58,000, then what will be the percentage? 8,000, and when we divided 8,000 by 100, this will be 80%. So if it is an adjusted net income of 60,000, it means that 100% of child benefit payment received by that individual would be charged to tax. And if the adjusted net income is 50,000 or up to 50,000, there is no child benefit charge.